Hey everybody, it's Rich. As promised, I wanted to just go through this financial template for the new business planning project in just a little bit more detail. We'll actually just walk through an illustrative example. As we discussed in our last class, there's 24 tabs to this workbook, and at first it can seem a little overwhelming. But I want you to keep it real simple and just divide this big overwhelming workbook into a couple of different chunks. So there's schedules 1 through 3, which essentially set the table for the rest of the workbook. And then there's schedules 4 through 10. So 1, 2, 3, 4, 5, 6, 7 schedules for each of 3 fiscal years. So fiscal year 1, fiscal year 2, fiscal year 3. So when you break it into more manageable chunks, I think you'll find this is easier to get your arms around. And I think you're also going to find that the way this worksheet is designed, although it can frustrate you until you're familiar with it, the way it's designed is that it flows from worksheet to worksheet. So if you concentrate on populating the yellow cells, the information you complete in Schedule 1 will inform Schedule 2. The information you populate in Schedule 7 might inform Schedule 4. So my advice is to fill out all the yellow boxes first, and then we're going to come and look at the income statement and the balance sheet for your 2 years, or for your first year, and we're just going to do a sanity check. Because what a lot of students realized last year is after they did that first year, they're like, oh my God, we have an unprofitable business. We have to revise our volume assumptions or our price assumptions or our cost assumptions. All right, so with that being said, let's just dive in. We'll call this Rich's knickknacks and stuff. Terrible name for a store. That's why I went into accounting and not marketing. So with these things populated, you'll notice it's going to populate throughout the rest of the workbook. So Rich's knickknacks and stuff bleeds all the way throughout. So my advice to everyone is, while it is necessary to populate the yellow cells, just about every other cell in the worksheet has a formula that links it to something else. If you toy with these, the ones that aren't marked yellow, you run the risk of kind of hosing the integrity of the workbook. And the last thing I want you to do is to present to a bunch of investors or creditors with a balance sheet that doesn't balance because you hard-coded a number into one of these cells. So let's assure ourselves of this, that we'll just stick to the yellow cells for the time being. So the first input in this yellow cell is annual revenue growth. So I'm just going to say, let's say in our first year, we're going to have, from year 1 to year 2, we're going to have a big uptick, and then I'm just going to say we're going to have more normal growth, still pretty nice growth, in years 3 to 5 as we mature. So a very simple assumption. So then we're going to jump to tab 2, or schedule 2, which is a pre-opening cash budget. So how much money do we have to have on hand to start this business? So for my little knickknacks and stuff, I'm going to say I want to have 20 grand in cash. I need 50,000 worth of knickknacks in inventory, and I might have a few other oddball assets. We'll say 5,000. So for land in a building, we'll say 100,000. Furniture, oops, forgot my decimals there. Furniture and fixtures, 5,000. Equipment, 1,000. And I think that'll do it. Pre-opening expenses, this might be legal consultations and things like that. I'm just going to say 20,000. Not exactly sure. So you'll notice as of right now, this says excess cash, financing required. So this is what I need to start the business. I'm going to have to capitalize it somehow. So I'm going to say, I'm going to put up 50,000 into this business myself, which means I've got to obtain financing of quite a bit. So we'll get to that in a second. But for the time being, we'll put Schedule 3 to rest. And you'll notice this blank cell that was not colored yellow is linked directly. So for those of you not familiar with Excel, you can click on this to take you there. There's also formulas where you could trace dependents, and it'll show you basically how that how we arrived at that number. That's another example. All right, so go on to Schedule 3. So we need a loan, a mortgage for our land, and a term loan for the other excess cash needs. So let's just say annual rate will do 5%, and for the term loan we'll say 7%, and the term on that is 5 years. So the schedule kindly calculates an amortization schedule for you. So this makes it really, really easy to do. So we'll continue. Schedule 4, this is our annual sales forecast. So I'm going to say knickknacks are a hot seller around, we're a seasonal business. So I think we're going to be selling like hotcakes leading up to the holiday season. And let's just say we slow down during the summer. We start picking up steam. So I'm basically doing some seasonality into this business. You might have seasonality based on the nature of your small businesses. So now that we've populated this, we could go back to that Schedule 1, and you can kind of see how these inputs that we put, the 20 and 10% growth rates, now take into account our monthly sales from year to year. So pretty slick design if you can be patient with it. So now we're going to do contribution margins or gross profit margins. So I think I'm going to sell, if I sell a knickknack for $1, I think it's going to cost me 50 cents. So I'm just going to say I have 50% margins. I think for rent, I'm going to say 0 because I own the building. Legal and accounting, I'm going to pay the best accountants in the world to do my bookkeeping. Insurance, we'll say that's 15 grand. Licenses and permits, knickknacks isn't too regulated. Advertising and promotion, 5. Utilities, 10. And office supplies, I run a pretty lean ship. So basically, what I just input is off the top of my head. To me, getting a number on these is going to take a little bit of research for you and your team. So we'll talk about that more. And since I'm a one-man shop and I want to make 6 figures, I'm going to plug my salary in accordingly. Land and building, I think I'm going to bypass that for the moment. Now we get into annual revenue, sales, and AR summary. So basically, you have to make a determination to what extent are you doing cash sales versus credit sales. So most of you for cafes, for retail shops, you'd be in the cash sale department because you're going to sell, you're going to basically get cash at the point of sale. Knickknacks and stuff, I let creditors run or I let customers run a credit line. So let's say 50% of my sales are in cash. So basically 50%, if I make 50,000 in sales, 25,000 are coming in cash, 25 are coming in credit. And of those that come through credit, I'm going to say 50% is in the current month, and then 25 and 25 within 90 days. And this is going to impact my balance sheet and my cash flow. The more you collect up front, the better off I think you'll be, but do what I think makes sense for your business. All right, so let's go to Schedule 7, which is the annual inventory, payables, and COGS schedule. And if you don't have inventory, for example, depending on the type of business you are, maybe this doesn't matter. So not all of these will apply depending on the nature of your business. So let's just say for all the purchases of knickknacks I make, I pay 50% of them in cash and 50% of them on credit. And of all those credit purchases I make, I pay 50% of them within 30 to 60 days, and where I can get away with it, I try to stretch my payment terms to 61 to 90 days. The idea being, if I can collect cash within 30 to 60 days, I can then pay it within 61 to 90 days if my vendors allow me to get away with that. All right, so all I have to do is input that, and it's going to populate the rest of these schedules. And again, we're just going to gloss over this, and we're going to see how our financials look to see if we have to do some retweaking. Next, we're going to talk about line of credit. So there's a couple of things here to fill out. So lines of credit, annual interest rate, this is already pre-populated. I'll just stick with that. Desired minimum cash balance, I want to have, well, let's just do 10 in the bank at all times as a new business. And my C Corp tax rate, so I just happen to be a C Corp, so that is the tax rate for us. If you're not a C Corp, if you're a partnership, that would be 0, and then the partners would pay taxes on their individual returns. So let's see. Cash paid for taxes, again, if you were a C Corp, you would do estimated quarterly payments. If cash investors are taking money out, I would highly doubt anyone would do this, certainly in the first year of the business. You have to take that into account in this line. I'm going to leave that blank for the time being. In Schedule 9, we get to our income statement. So basically, after all the things I've populated, let's see how things work out. So I have sales of $300,000. I have variable costs / cost of goods sold of $150,000. And you could probably tell where that's driven. I have a 50% margin. Operating expenses of $150,000. Interest expense, which looks a little bit strange to me. That might require some tweaking. I may have just flipped a sign, but we could troubleshoot that, and that's kind of how this project works, is that when you see something that doesn't make sense, you have to back into where it came from, and in this case, I'm willing to bet I put a positive number in where a negative number should be. In any case, ignoring that small interest expense thing, my first year total expenses is pretty high compared to my income. My income tax is relatively steep, so I probably have to scrutinize that. And my net income is a loss. My net profit margin is unfavorable. So at this point, I have to say to myself, does this make sense for my business? It's not uncommon to operate at a loss in a business your first year, but right now I'd say interest expense looks a little bit balky. So I'd troubleshoot that by going into this formula and backing into it. I would also kind of scrutinize the income tax expense to see if that makes sense for this type of C Corp I am with the amount of income I am, just to double check that. And then lastly, Schedule 10, this is the balance sheet. So you can populate useful lives here. This is going to impact your depreciation figures. But just at a glance, this kicks out a balance sheet that is slightly off, and there's my problem. So right off the bat, I'm looking to see if assets tie to liabilities, and they don't. So you remember, total assets should equal total liabilities and shareholders' equity, and it seems when I put mortgage payable, I inverted a sign. So this helps me troubleshoot. If you don't have a balance sheet that balances, you got an input error. So in my case, I do, and I have to fix that input error before I even go about trying to assess whether these balances make sense for the nature of my business. So anyway, you'll repeat this exact same process for years 2 and 3, and you'll have to troubleshoot along the way. The troubleshooting is kind of the bread and butter, and testing of this exercise, and testing your assumptions is the bread and butter of this exercise. So there's no way to do it except to immerse yourself in it. So cut yourself loose, have fun with it as much as you can, and we'll regroup on Saturday to discuss your assumptions and where things went a little bit sideways or haywire. Thanks, everybody. Take care.